Hey everyone, and thank you for joining us for this year's 2021 Federal Budget Breakdown with Chris Carlin, James Wrigley, and myself, John Cachia. Us three fellow advisors thought it was a bright idea to put our bright minds together to help you guys really break down the federal budget. I hope many of my clients fell asleep last night because I was definitely up doing my job, and I know these fellas were doing the same. So, without further ado, I'll actually just get these guys to introduce themselves. We might just go around, just do a little bit of a 15, 20 second just on who you are and your business and a little bit about yourself. And then I'll finish off for the people who don't know me, letting you know a little bit about myself. Chris, over to you, mate.
Yep, so my name's Chris Carlin, founder, financial planner and mortgage broker at Master Your Money Now. Our aim is to help everyday millennials, especially nurses and teachers, to help with their finances. Based down in Geelong, home of the Mighty Cats. And very excited to be on board for this webinar because there was a lot of information in here for particularly first home buyers, which is our sweet spot. We help a lot of millennials. Our aim is to help millennials buy their first home in the next 12 months. And there's a lot of things in this budget which will help millennials to be able to do that.
Awesome. That's great, mate. So, you'll be tackling the home ownership stuff out of the federal budget, mate. So, thank you for jumping on board. James, over to you, mate.
Yeah, John, thanks for organising this. So I'm James Wrigley. I'm a principal in a financial planning business called First Financial. We typically don't work in that first home buyer space. Probably our client demographic is probably mid to late 40s plus. They're often people that are settled well and truly settled into their family home and a couple of kids and trying to smash down a mortgage, big incomes, and through to retirement. So we do a lot of work in that kind of pre-retirement and retirement planning space. So again, there's a whole lot of changes. Somewhat surprisingly, I wasn't sure that there would be some changes around superannuation and pensions and eligibility and stuff, which we'll tackle shortly. I don't know about you guys, but I never actually watch the budget. I figure we get enough stuff in the inbox the morning after that I've long given up sitting there watching the budget myself. I just read the recaps after.
The speech is the best part, though, isn't it? It's like, I always say budget parties, but no one seems to want to turn up, which is strange. Yeah. So, I hear what you're saying. It's there's certainly plenty of information out there, but there's also probably too much information. So it'd be great to break this down to the areas that are relevant to our respective client bases.
Mm-hmm. And James, I think I just stay up out of habit, mate. I think just being there and doing it for so long, year after year, I think it just becomes one of those things. It's like Brownlow night, So same scenario. So quick one over to me. For those who don't know me, my name's John Cachia. I run AFA Group Wealth out of Essendon or Nidri in Victoria. We help everyday Australians to essentially reach their financial goals. So pretty much helping ambitious people kind of put the life that they had behind them and really tackle and reach their goals. So what we've done today is try to get everyone in their respective camps to give their opinions and share a little bit of thought. So for those who are watching this on YouTube and on Facebook, leave some comments and I will try to answer them. Please bear in mind there is a few people watching, so I will try and attend to them now. If I can't attend to them now or we can't attend to them now, me and the fellas will try and attend to them later. Okay, so before we actually get started, I would have to say that I really saw this budget as a let's get the votes budget. This really was a pre-election budget, wasn't it? There wasn't a lot of bad stuff in there.
Yeah, this is definitely a budget designed to win some votes, which is a cycle that you see. The budget before an election is always the spending one. The one straight after the election is the austerity one. So, I think there's plenty of areas that are covered. There's areas for funding for aged care. There's funding for women. There's funding for infrastructure. There's funding, obviously, for the vaccine rollout as well. There's so much support out there. This is definitely designed to win votes. And I would dare say that whilst I'm not a political expert, that we're probably going to be going to the polls in the next 6 months.
Yeah, this just felt like, it was the cinematic movie that, financial people were waiting for. It just was like, throw everything in. I'm a Marvel fan and this had, Infinity War all over it. So anyway,
so
That's exactly right. So, guys, what we'll do is obviously because most people are watching this on a post-lunch break kind of arrangement, but what we'll do is we'll get straight into it. Now, everyone, please bear in mind, because it was so action-packed in regards to all of these different changes, we have kind of summarized into the major areas, which is home ownership and superannuation and kind of retirement. What we will do is we'll cover some of the other points very briefly, but these are going to be the two main areas that we are focusing on. And please, if you want to know more, me, Chris, and James would be happy to answer any questions. Like James said before, we get inundated with detail around the federal budget, and we'll be happy to circulate to whoever needs it. All right. So before we actually get started, obviously all three of us are qualified financial advisors, but we do need to make you aware that any of the discussions or opinions that we're making or any of the advice that is being circulated is of a general nature. Please do not take this as personal advice. Your personal advice should be looked at specifically and then actioned accordingly. And I'm sure you guys will back me up in kind of saying that. There is a lot of general advice going on. Please, guys, seek personal advice in regards to your personal circumstances.
Absolutely.
All right. So what we're going to do, obviously, Chris, it is a little bit of your kind of focus area in obviously helping first home buyers. So I might get you to kind of cover some of these points initially. Prior to this, I actually had a few questions from some individuals in regards to this. But mate, over to you. What did this budget have in for homeowners, especially around first home buyers?
Yeah, so probably the two big schemes that we look at for those who are looking to buy their first home is the first home loan deposit scheme and the first home super saver scheme. So first home loan deposit scheme, for those who don't know, it's where you only need for 5% deposit to avoid paying lender's mortgage insurance, which is fantastic. If you're looking to buy a $500,000 house, rather than needing $100,000 to avoid that lender's mortgage insurance, you only need $25,000. So it's a great way for everyday people to get into the property market sooner, and those who are looking to take the first step into buying their first home, which in my opinion is definitely the hardest step. Now, the good news is there was a bit of question marks regarding whether this scheme, which started in 2019, whether this scheme would roll over into 2021. And we can confirm that that is the case. There will be another 10,000 spots available for new and existing buyers come 1st July 2021. So those sort of spots are going to fill up very quick. They'll be gone by the end of August. But and so definitely for those who pre-planned, like a lot of my clients, to get into that scheme to buy their first home, the good news is there is 10,000 spots that are going to be there. On top of that, there's going to be another 10,000 spots specifically for those looking to build a new home or buy a brand new home. So there's in total 20,000 spots. So those new home spaces are continuing. They all take a lot longer to fill up. So there's probably not as much of a rush for those new home spaces. But yeah, great news, 20,000 spots available for first home buyers who are looking to buy their first home or build their first home. One thing that hasn't changed as we currently hear it, and it's probably a little bit surprising, is there's quite strict price caps in terms of what your income's going to earn, but most importantly, what your property price limit's going to be. So that varies from suburb to suburb. In Sydney, it's 700,000. Melbourne, Geelong, it's 600. Regional Victoria, it's 375. And so it varies from suburb to suburb. Those price caps have not changed. And I must admit, that's a little bit of surprise, noting where property prices have generally nationally gone up 10% over the last 12 months. I am quite surprised there hasn't been a change there. So there could be some news coming on that. I haven't totally ruled that one out. But yeah, as the rules currently stand, the price caps are still quite low and restrictive. So hopefully there's a bit of a change there, but as it currently stands, it's business as usual for those caps. So that's the summary for the first home loan deposit scheme. Now, the first home super saver scheme, that is for those who are using their super to save for their first home. So most people know your employer is putting in 9.5% currently. It's going to go up to 10% in a couple of weeks, but it's 9.5% currently into super. You cannot use that for your first home. However, if you were to put additional contributions to your super account in terms of salary sacrifice or after-tax contributions, you can withdraw that money again for your first home. And as the rules currently stand, you can put in up to $30,000. And if you set it up right, you get a 15% tax benefit, which is an extra $4,500, not working harder, not going smart, just working smarter. So that cap is now increased to $50,000. So that means the total tax benefit is $6,750. However, now that's kicking in on the 1st of July 2022. So for those who are putting a lump sum on the 1st of July, like a few of my clients, unfortunately can't take advantage of that. But what hasn't changed? So that $30,000 to $50,000 is the lifetime cap. There's still that annual cap of $15,000 that's there. So that hasn't changed. So I actually, the more I reflect on this, the more I think that this actually isn't as good as it sounds with that $15,000 annual cap, because that's 3 financial years or 4 financial years that you've got to save for to get that full $50,000 cap. And if you get a house under the first home loan deposit scheme, 30 grand is probably going to be enough for you in most areas to get into the property market. 50 grand will be handy, but most of the time 30 is sufficient. So it is there. If you're looking a bit more longer term planning, there is some tax advantages there. Yeah, with that $15,000 cap that's still there, it's probably not as good as it sounds. But it's good to know the government still is in support of this scheme. It's a great way for millennials to get engaged with their super, and it's again a great way to save your first home and reduce paying tax, because who likes paying more tax?
It's effectively just making that the scheme itself hasn't really changed. It just means that you can do it for longer.
Correct.
To buy. So it's almost, you're wanting someone that's maybe 20 years old to be starting to think about this, not someone that's their mid-20s and then looking
buy in 12, 24 months. Correct. Yeah. Again, with the future, it is, that's a good point. And if you're future planning, putting in that extra 20, 50, $100 a week into your super, that's probably a good scenario for you to use the full 50 grand. But if you're looking in the next 12 months, then you probably can't use the full 50.
Yeah, right.
So we've actually got a couple of questions, Chris, that have kind of come in. So one of the ones that we actually got was, can you use both of the schemes together? So can you use the first home buyer deposit scheme and the first home buyer super saver scheme together?
Absolutely, you can, and that's something we help our clients all the time with, getting them into the super saver scheme, which is not capped on places, but the first home loan deposit scheme is capped on places. So that's where managing timing and getting the right advice makes a huge difference. But yes, you are able to get into both of those schemes.
Okay, the other one is if obviously there's 10,000 spots available or 20,000 spots for new and existing, for the people who miss out on it, obviously I do mortgage broking as well. Obviously there's obviously the lender's mortgage insurance that does come into the forefront of this. But do you want to maybe explain to them, for the people that do miss out, my thing is obviously don't be too disappointed. There is other ways, but Chris, if you want to just answer that one.
Yeah, look, this is where a range of traditional options, for lack of a better word, comes into it. There is still, you can still pay lender's mortgage insurance, and particularly if you're in a regional area, it's not too bad. Bit different if you're looking at that $600,000 to $800,000 mark. LMI is quite high. There's still the option of parents' equity, and there's still a few banks that offer 15% deposit, no LMI options. So that's good. And also there's a few occupation ones as well, particularly if you're in the medical space, where some banks would give you just a 10% deposit regardless of your first home, second home, investment property, etc. So there's a few different options there. So if you're unable to get into the scheme, and it's definitely a case of get your elbows out and start planning now, if you want to get in on that 1 July scheme, talk to your mortgage broker about a broad, and there's still plenty of options there for you to get into your first home. Look, paying it for lender's mortgage insurance is not the end of the world if it gets you into your first home sooner. But obviously, if we can avoid paying lender's mortgage insurance, the better.
That's it. Well said. Another one. Do all the banks offer this loan scheme?
No, No, they
Yeah.
don't. So there is a list of banks that are approved for the scheme. So
I
for the
think
big banks,
NAB and CBA were kind of
NAB
earmarked for
and
the current ones.
NAB and CBA are under the big out of the big four banks are part of it, and then there's a range of about 25 small lenders as well. So, so definitely ANZ doesn't offer it. Westpac Group doesn't offer it. Just make sure again when you're talking to your mortgage broker that they're obviously aware of this scheme, which they should be, but just note that not every bank is part of this scheme. So there is a list available online of the smaller banks that are available for this scheme, but no, not every single bank is able to participate in this scheme.
Yeah, beautiful. Well said. One you were going to cover was on regards to the single parents, which was an interesting one. So do you want to speak about that?
That is a really interesting one, and we're still waiting for a bit more information on this because this is a vastly different scheme. But effectively, what it's designed is for single parents. You only need a 2% deposit to buy a property. Now, it's not clear in regards to whether this is a property, whether it's a first home, a second home. I'm assuming it doesn't cover investment properties, but I haven't heard information that says it doesn't cover investment properties, but I'd be very surprised if it did. Really help single parents, which is, as you would know, the hardest time to save, if they've got a 2% deposit to get into the scheme. Now, if it's their second property, then stamp duty and all those kind of things, my understanding that is going to be applicable. So you still need more than 2%. But if you're a single parent, particularly in regional areas and struggling to get that first step into the market, that would be a good way to go. Also, a lot of single parents are paying pretty high amounts in rent. And so with that rent, it's very hard to break that rental cycle with a 2% deposit. And if you're with interest rates where they are at the moment, your rents could be very similar to what you're paying for a mortgage. It could open some options. So we're still waiting for a lot of information. It's still going to have the same price caps as the first home loan deposit scheme and be administered by the same administration group, which is NAFIC. Don't ask me what that they mean, but so a lot of similarities, and there's only 2,500 spots available each financial year for the next 4 years. So I think this is more of a trial and see how it goes. But definitely if you're a single parent there's some options there.
I was just going to say, Chris, it probably is interesting to know if these single parents can obviously apply for both, and how it would be viewed. It would go as a ranking, like first home loan deposit scheme, as a single parent, then if they don't get into the 2,500, they then go into the 10,000, or is it you go for one and not the other? It'd be very, very interesting to see how this is administered. And there's a few clients that are obviously coming in my mind, and I'm kind of thinking you just have to apply to both and hope you get one of the spots.
And it's also one of the things, it's all well to have the government guarantee, but then it's come down to bank criteria. And I think bank criteria might be be a bit of a stick in the mud for this scheme, because the banks still want to make sure that you are you're a person that can repay that mortgage. So we're interested to see how this plays out, but the potential is definitely there.
All right, beautiful. Thanks for that, Chris. Everyone who's listening and watching, obviously, if you need to know more, Chris will be probably trying to answer these home ownership questions for the individuals. I'll be jumping in there as well, and James will provide his feedback as well.
That was actually learning a lot here, listening to that too. I don't work in that space whatsoever, so to hear how it all works, that's great. Thank you for sharing it with me, and let alone anyone else that's watching too.
Yeah, and this is, I think, the value of us kind of coming together, everyone. You'll start to realise that everyone's got their specialty in regards to what they do. So, we think that, 3 heads are better than one. There was going to be another person adding in who will come in at a later date, but he's recently just had a child, so we'll keep him under wraps for now. We'll let him out of the cage on our next one. But let's jump into superannuation now. Obviously, James, this is very, very familiar for you. Like you said, it was probably surprising the amount of changes that kind of came in. But if you want to kind of just run us through these, we've already got some pre-questions for these as well. So great interaction.
Yes, it was somewhat surprising the level of changes that are coming in, and you've got some points there on the slide which I'll touch on, but I'll maybe just bring up firstly some indexing of contribution caps that are coming in on the 1st of July. So this actually has nothing to do with this federal budget. It was announced previously. Those caps are tied to wages growth effectively, and so they go up every now and then. And so they're about to go up. I guess that's only useful for anyone that was already using all of their caps anyway. So if you were just earning your wage and collecting your default super contributions and not really doing anything about a bit more longer term planning in relation to superannuation, well, they don't really mean anything to you. But so the caps are going okay. You can see you've got the slide there on the screen. So the pre-tax contribution limit, or what's called concessional. So that's the part where your employer is currently contributing to superannuation on your behalf, plus any voluntary salary sacrifice that you might do, or tax deductible lump sum contributions. Currently, that limit's at 25,000. From the 1st of July, that's going up to 27.5. Then the flow on from there is there's an indexation up in what's called the non-concessional contribution, or that's like an after-tax lump sum of money that you might take from a bank account, some inheritance. Selling properties is one of them, and there's some separate rules around downsizing, which I'll touch on as well. But wherever you've come across this lump sum of money and contributing that to super, so that's going up to 110,000 from the 1st of July. That's currently sitting at 100. And then there's this thing called bring forward. So you can group together this current year plus the next couple of years to put in an after-tax or a tax-free lump sum of what's currently 300,000. If you wait until the 1st of July to do that, it goes up to 330,000. Now, in all of that, there's always been a bit of complication around someone's age. And so one of the announcements in this federal budget, and maybe this federal budget was a bit unique, and there was a technical session that John, you and I attended, the same one earlier this morning, and the presenter there mentioned something. I thought, that's really sneaky. Typically in the past, when they make announcements around changes to superannuation, they say, as of the 1st of July 2022, this is what the changes are going to be, just as what's happening with these contributions, 1st of July 2021. All of these changes around eligibility to contribute to super and others that are coming, we're all around this will come into effect the beginning of the financial year after these laws receive royal assent, which is in a roundabout way saying, well, so long as we're still in government and still holding the power and we can push it through, well, then this is what we're planning on doing. But if you don't vote for us in the next election and we're no longer here, well, we can't control it, and maybe all of this stuff that we're promising might not actually happen. So that's a bit of a different one to what we normally see. Do you want to flick back to that other slide?
Yeah, I will. And I think that's a very good point for the listeners or the viewers that are on this, is really to understand that a lot of this stuff needs to get royal assent. So essentially this needs to be put into legislation, guys. Yeah, a lot of this is just proposals, okay? So it's very important to know that, okay?
Yeah. There's very few things that on the odd occasion they'll say, as of 7:30 budget night, this thing is happening, but that's on the rare occasion that does. So I guess there's going to be a bit of a simplifying of things, which is great. A lot of the clients that I work with that are kind of transitioning through to retirement, those last couple of years of their working lives, in years gone by, that was maybe in the realm of maybe 55 to 60 that they were starting to wind down and call it quits. But more and more common is people working through to 60 to 65 and beyond. And if someone's not working under the current rules, if someone's not working after age 65, it was getting quite difficult to put money into superannuation. The government extended that a couple of years through to age 67. But one of the proposals in this budget is to scrap this thing called the work test altogether. So really the only thing you need to keep in mind is, am I under 75? Well, yes, if I'm under 75, well, then I can take advantage of contributing money to superannuation. So expanding the ability to utilize non-concessional contribution bring forward rule to people ages 67 to 74. There's an argument to make, and again, this was mentioned in that session this morning, as to whether we actually need the bring forward rules. My personal opinion is yes, we do. Most clients that I have that come across some money, we're actually staggering some timing to say, well, let's put a bit of money in this financial year and then put a bigger lump sum of money in next financial year. If that's from, I've got some clients I'm doing some work with at the moment who've sold a holiday house. It's not being used. They don't want it anymore. They've sold it into this booming property market and wanting to work out what to do with the super. So I think the bring forward rules work. In terms of timing, it gives you plenty of time to get money into super, but the ability to put in a lump sum, I think, is very valuable.
I definitely think that there's definitely a place for them, and I'd rather have them than not.
Rather have them than not, that's for sure. And look, it wasn't that much of a big deal for someone that was over 65 if they got some inheritance or that they got some money from somewhere. It wasn't such a big deal because of the tax-free thresholds and all the rest of it. Between a couple, they could have the best part of $1 million of investments outside of super and not really worry about having to pay tax on the earnings. It's just painful because they have to continually do tax returns or they're lodging claims for refund of franking credits. Whereas if they have the ability to put that money into super, it's just one less thing they have to worry about. It's in the super fund. The super fund has always had to do the tax return and everything anyway. And it's just one less thing that they have to worry about themselves. So it's good that it's available. So I guess we'll move on from there. The downsizing one, so that third point that you've got there. So some rules were brought in a couple of financial years ago where someone over the age of 65, if they'd owned and lived in their home for more than 10 years, and they sold it, they could put in up to $300,000 per person or $600,000 per couple into super to top up their super. Now, I've helped a lot of clients work through this. There's not very many that have $600,000 left over from downsizing their home. So it's not unless they're selling something for multi-millions typically, and then buying something that's worth a whole lot less. But if it's an average house in the suburbs and maybe they move to a retirement village or they move to something else smaller, they might have $100,000 or $200,000 left over. So very few, in my experience anyway, use the full $600,000. Nevertheless, it's there. But this does open the doors to people making use of those rules a little bit earlier in life. So rather than needing to be 65 to do it, doing it at age 60. So there'll be a few more. And, the government's just trying to encourage, it's one thing around housing affordability. If they can try and encourage those that are older, typically the empty nesters, kids have moved on, that are living in a nice big house in a middle ring suburb of a capital city, if they can encourage them out of there into something a little bit smaller, well, then it helps with the housing affordability as well.
Good points. I think James, the last 2 points are probably very, the second last point is probably very limited. Guys, just so everyone knows, there's some certain pension accounts that have been lying around for a long period of time. And they've essentially allowed a specific amount of time. I think it's 2 years, James, a 2-year period.
There's a 2-year window they're going to introduce,
to be able to kind of roll out of those. I think anyone who has those legacy products would need to speak to a financial advisor on the importance of rolling them out. It's one of those things that it's so specific to the individual. Please, anyone's got those legacy products, speak to a financial advisor in regards to if that's a good opportunity for you or not. Okay.
I've got one client at the moment that they're one of these legacy products. It's just finishing. They've got a self-managed super fund, and this client's had to pay out $90,000 from his self-managed super fund because it's the end of his term allocated pension has come to an end of its term. He's had to pay out $90,000. He doesn't need $90,000. He doesn't want it, but he's too old to put it back in again. And under the current rules of his pension, it's just forced out. This would have otherwise allowed us to undo that, and he could have kept that money in the super fund for a bit longer.
James, just jumping in there, is particularly with the changes to the work test, does this open? I've heard this opens up some really good estate planning strategies and reducing tax to non-dependent beneficiaries.
Yeah, absolutely. So a strategy that we implement, and I'm sure that the two of you do as well. It's when once someone's retired or they've met a what's called a full condition of release, once you have full access to someone's superannuation benefits, often a strategy that we implement is pulling money out of their superannuation, wherever it might be, and then putting it back in again. If you're doing that over the age of 60, that withdrawal that the person is taking is tax-free. They can put it back into super tax-free using these non-concessional limits. And behind the scenes, it changes the components of their benefits. So to that individual, it makes no difference whatsoever. They're over the age of 60. Whatever they take from super is tax-free to them. But it's of benefit to the next generation, typically their kids, where if they're inheriting money from superannuation that is made up of something called a taxable component, they'll pay tax at 17 cents in the dollar on that taxable component. And so if you've got, we do this strategy, and when you run through the numbers, for the sake of messing around with a bit of a withdrawal and putting money back in, it's tens and thousands of dollars. $50,000, $60,000, $70,000 is not uncommon to be saving in effectively like estate taxes, death taxes that would otherwise have been paid. This opens the door to that. There always used to be this mad scramble to try and do it before age 65. But with people working that little bit longer, kind of really sandwiching up against age 65, it was getting really tough to actually do that.
Less and less common because of that. When I first started in the industry, it was probably more common, and as time's gone by, like I think you hit the nail on the head. It's that we're working all the way through, so we never actually got that full accessibility to that money early. So sometimes quite difficult.
One of these transition to retirement pensions, but there's limits around how much they can take out. So this, does extend that out a bit. So anyone that does work to 65, 66, 67, which I'm seeing is more and more common, we can implement some of these estate planning strategies to great effect. Yeah.
I think, thanks for that, mate. I think on the last point, guys, there wasn't any mention for any changes to SGC or employer contributions. So we would probably all assume that we're going to 10% as the 1st of July. I think we've got a consensus on that, that we're all moving to 10%. I think the other one, mate, we're doing a bit of this, and obviously probably more for mine and James's clients. Obviously, the reversion of pensions back to pre-COVID levels. So we would also assume there was no mention in regards to the extension of reduced pension allocation. So just so everyone knows, during COVID, they allowed for pensions out of superannuation to be reduced by 50%. So, for example, if your minimum requirement was to take out 5% from the allocated pension, it was now all of a sudden 2.5%. And that was really good for a lot of clients. That allowed them to hold money inside their superannuation pensions, especially in a falling market. In most cases, it allowed that money to be invested for a little bit longer and not take out while potentially markets were falling. Well, that comes to an end come 30 June. So, there was no mention on extension of that. So I would say all three of us have the consensus that that's going back to normal.
Yeah. I think that's going to go back to normal, and the bit of a surprise that you might see for some people that did elect to take that 50% reduction is that chances are the benefits in their pension fund are a whole lot higher today than what they were back on the 1st of July when that minimum was set. So not only are we getting a doubling of it going back up again, it's also then off a higher balance. Those balances might be up 15 or 20% from where they were last year. So it's a higher number and a higher percentage, so you get a significantly, significant boost up in what might be forced out under these minimum pension requirements.
But in saying that, with these changes coming through, especially for those age 67, then we can just chuck it back into super. So
hopefully,
yes. It's not all doom and gloom.
This is why it's a pre-election budget. What we think is bad, they've tried to make good. All right, so I've just got a couple of questions. Obviously, I think we've answered both of them just in regards to the contributions going up to 10%. I would say there's a consensus that is happening. The other one is, does this mean if I'm 68 years old and not working, I can contribute into super? James?
Today, no. If these rules come into effect, as we said at the start, that's subject to your working. If you're not working and 68, but it's subject to these rules. becoming law, then yes, you'll be able to. So I was talking to a client just this morning. They're taking a big lump sum of money out of their superannuation fund to buy a motorhome. They can't travel overseas, so they're going to do some travelling around Australia. But these rules will now line up for them that in a couple of years' time, once they've had their fund, they'll be able to sell the motorhome and put whatever's left over back into their super fund, which is they wouldn't have been able to before.
Oh, awesome. All right, and keep those questions coming in. We've had great interaction, guys, and a lot of viewers on, which is awesome. So everyone must have gone to sleep last night waiting for this to be on today, which is awesome.
Just all on right. That 10% thing there, John. I had a question earlier, and anyone watching, it might be something that they're thinking about. This increase in the super guarantee won't necessarily mean you're going to be paid more. It depends on how how your pay is structured. So if you earn,
good point.
If you're on a $100,000 a year package, part of that would likely go to super, and then you get whatever's left over. We may see some employers that just go to 10% goes to super, and so you get a few less dollars in your take-home pay. Yeah.
It's got to be, even though can happen, it's one of those ones that you've got to be a prick of an employer to put that through. So to all the employers out there, I think we would all have a consensus in saying that there's more needed to go into superannuation contributions for many people. So the extra 0.5% is probably needed for many. Now, guys, there's a hell of a lot of other measures that are being introduced in this budget as well. There is a few dot points that I've kind of put on here just for us to kind of skim over. I think from a tax perspective, guys, the low to middle income tax offset is essentially they're going to roll it over one more year. And what that essentially means is for an individual, that'll save them about $1,080 for the higher income brackets. Any commentary around that? I think that's pretty self-explanatory. It's happening at the moment. It's just rolled into another year. The next one in regards to individual tax residency rules are simplified and modernised. I think from that perspective, it's just being more simpler. If you are in that situation, I think speaking to your tax advisor in regards to that is probably the best discussion to kind of have. Any commentary around that? I think that's more individualised. Or James, did you have any?
I'm not sure if this is totally linked to that one, but I know the SMSF rules are changing for requirements to be a resident. I thought that one was really interesting. Now you don't have to be in Australia for a longer period of time in order to retain your self-managed super fund. So particularly those who are in the expat space, that does open up a few different options, and probably a reflection of at least pre-COVID, the global world that we're living in. So that's definitely a tick as well.
Eligibility to contribute a massive one to the self-managed funds.
Yeah, correct. Obviously, a few others, I think, for the accountant as well, just in regards to temporary loss carryback measures being extended for a further 12 months, the temporary full expensing. Those are the things, guys, like, for example, businesses going out and buying certain things for their business. They're just being pushed out for a further 12 months to help stimulate the economy, as they put it, get businesses spending some more. Changes to the pension loan schemes. I'm not sure if you guys do any of this, James, in regards to pension loan schemes. We don't do many of them.
No, I haven't done any, but I know of it, but I haven't done any, no.
So, guys, this is just a Centrelink on the loan scheme that can be arranged through Centrelink for some people that are on the pension. Additional support for older Australians through the home care services. I didn't put one on here, but I will just finish off on the aged care. So there are some measures in the response to the Royal Commission in regards to aged care, and there are a few ranges of measures that they're proposing as well. But I think the other one is the childcare subsidy, which I found was really, really good. There's a lot of points and packages going around at women. Okay, and they've kind of straight up come out and said that it's for women, and I think that the childcare subsidies and the incentives around that is there's a lot of women that were out there that weren't going back to work essentially because I'm going to work, paying whatever it is, getting paid whatever it is, but I'm paying X in childcare. So they're really trying to incentivize, people to go back to work. So the subsidies are around incentivizing people to go to work and making childcare costs much cheaper and cost effective for them to continue to work.
It's a big expense.
Big expense.
I've got one left at childcare. Chris, you'll maybe a little way ahead for you.
I've got a little way to go, but yes, I know for a lot of people, childcare is their most expensive years when it comes to education, their kids' education. So, more support to that, the better.
Yeah. So guys, thank you So guys, thank you very much for obviously jumping on here. Everyone who's on here as well, thank you very much, and we really appreciate it. Hopefully, this has been of great value. I'll be coordinating on the Facebook pages and on YouTube as well. I'll be introducing Chris and James as well too. If you guys have any questions, reach out to us. We'll be more than happy to answer your questions. Hopefully, you've seen this of value. We definitely were very intrigued with the budget, and we'll see how these go. Getting Royal Ascent.
Sounds good. Thank you very much, Organiser John. Thank you, James, for your time. It's been great to have a chat.
Cheers, guys. See ya.
See you guys.
See ya.
Yeah.
Bye.